Good morning and welcome to the Lotus Resources Investor Webinar and Conference Call. All attendees are in a listen-only mode. If you would like to ask a question, please enter it into the Q&A panel within Zoom. I'll now hand over to Lotus Managing Director, Keith Bowes. Thank you, Keith.
Thanks very much, Nathan, and thank you and welcome to everyone who's attending the webinar. As I hope everyone has seen, we announced our definitive feasibility study this morning, which we're very, very excited about the results. And the webinar today is really for me to talk a little bit through the success that we've had with the feasibility study, but also to open up to the panel to answer any questions that people might have regarding the results from our feasibility study. So I'll jump straight into it. Just before I start, of course, the normal disclaimer page concerning any forward-looking statements that I may make. This is, of course, up on our website and is on the presentation, which is also up on the website as well. So let me start off with the highlights. What exactly have we been able to achieve with our DFS? Well, I think what's happened is we've been able to confirm a lot of the things that we addressed or that we identified within our scoping study, and really been able to confirm those and really bring a lot more confidence around the results we're talking about. So we have confirmed that there is a quick restart to this asset. We're talking about 15 months for first production, post making our final investment decision. We're talking about a low initial capital. We're talking about $88 million to be able to restart this asset back up again. We have improved the operating costs over what was seen both in our scoping study, but also when the plant was operating previously. So our C1 costs during the first 7 years is around $29.10, and our all-in sustaining costs of just over $36. We have a robust mine life at the moment, 10 years of mine life, producing 19.3 million pounds over that period, of which over the first 7 years, we produce on average 2.4 million pounds per annum. The project itself is fully permitted. We have our environmental and our mining licenses in place. We're also very, very happy with what we've been able to do around our power supply as well. We've been able to reduce the emissions that are generated from our power systems by over 72%. And that's been achieved by effectively moving away from diesel gensets. We also have very high certainty regarding the results presented here. 96% of the uranium produced comes from ore reserves. And we also have a relatively simple operation as well. It is an open cut mine with a strip ratio of 1.8 going down to a depth of about 160 meters or so from surface. We have a proven flow sheet that we've also improved upon with the inclusion of some new technologies that we've been talking to the market about for the last 18 months or so. I think it's also important to note there were a number of issues that the previous owner had when they operated the mine, and we've been looking at those in extensive detail over the last 18 months or so. The first one I think to talk about is what's happened with regard to the pit. So there was some instability on the pit benches and on the ramps that were used for the mine. And this is really based on the mineralization and the types of rocks that occur within the pit. There's effectively a number of different layers of what we call arcos and mudstone units. And what we were seeing is there were some failures at times when ramps or benches end up in those mudstone units. So based on an extensive amount of geotechnical work, we've actually redesigned the mine such that we ensure that all of the critical pieces of infrastructure, let's say, like the benches and the ramps, are actually based in more solid material. We've changed the system so we actually configure it in a much more safe and workable manner. And we've also improved the geometry of the pit such that the opportunity or the possibility of a failure is much less than what it was previously. We've also been looking at the tailings dams specifically from a dynamic stability point of view. We've been looking at these GISTM standards, which are the new standards around tailings, and we've made sure that we're complying with those. And we've designed our wall construction such that our factors of safety are well within the GISTM requirements. We've also been looking at the plant terrace stability. There's been some ground movement in that area over a period of time. We've been doing some detailed work around that has covered things like field test work. It has also included some significant analysis through 3D finite element modeling. And we've identified a solution which includes installation of a pile wall retention system and unloading the slope, that we believe, based on this modeling, will reduce that movement by in excess of 80% and end up with a much stable solution, or much more stable position for us to work from. I'll just jump into actually some of the results then. So from a capital cost perspective, as we said in the first slide over there, the initial capital costs run at about $88 million for the project. This is a capital intensity of around $37 per pound of annual production. Within the scoping study, we identified that the plant refurbishment costs were around $50 million. That number is still valid, but the additional costs that we've got in our capital, so those additional $38 million, are really to do with new capital items that we've identified. And these new capital items include a new acid plant, which we've decided to install, and that is combined with a steam turbine. There's a nanofiltration upgrade, the connection to the national grid, and also the upgrading of the front end of the circuit to include this ore sorting concept. So all of these new capital items that we have identified have been included in the project because they give us lower operating costs. There is a significant cost benefit to us including these items into our project so that we can drive those C1 costs down lower. So just regarding the C1 costs then, or all the cash costs associated with the project. So as we said, for the first 7 years, our cash costs are around $29.10 and an all-in sustaining cost of just over $36. When you look at the life of mine costs, these increase to just over $30 per pound for the life of mine, and all-in sustaining cost life of mine of just under $38 per pound. And I think it's important to note that these cost estimates have been done in the current high inflation environment. We do know that the improvements, that when we look at where we are now compared to what the historical operation looked like, and also what we announced in the scoping study, they are significantly lower. And the reason they're significantly lower is because of the implementation of these new technologies, like the ore sorting, which has increased the feed grade, the lower power costs from our connection to the grid, and our improved acid utilization through the use of the nanofiltration process, or nanofiltration circuit. So just talking a little bit about the mining and the geology. So as I mentioned, really simple open pit mining method. We understand the mineralization, we understand the rock types very, very well, and our mine design incorporates these geotechnical constraints that I spoke about with regard to ramp stabilities. Strip ratio is very, very low, talking 1.8 to 1. We're looking at 4 stages of mining that will occur over 6 years. Now, the strategy that we've pursued for the project is we do 6 years of mining. The remaining 4 years, to make up the 10-year life of mine, consists of treating stockpiles. So those are either stockpiles that are currently on surface from the previous mining activities, or they will be stockpiles that will be added to as part of the 6-year mining process. So 6 years of mining followed by 4 years of stockpile treatment. The depth of the pit is relatively shallow, about 160 meters. And as I mentioned, we've pushed the angle back on the pit to try and reduce any ground movement as possible. So our actual average pit slope angle sits at only 22 degrees. We're going through a contract mining route. We've identified a number of contractors and selected a preferred one based on a budget quotation we received for them. And as I mentioned, we've declared an ore reserve. And within the feasibility study, 96% of the uranium produced comes from that ore reserve. Talking about the processing now. So the majority of the processing plant will be the same as what was operated by the previous owners. And this operated successfully for 5 years, producing 11 million pounds of uranium. The plant itself remains in good condition. And as I've said through the capital cost slide, the refurbishment's about $50 million. And when we did a rough back of the envelope calculation, we believe that to build this plant today would cost us something in the order of $300 million. Now, as I said, we're using the same core processing method that was used before, but we've added on these additional items that are really helping us drive these C1 costs down. So this is the front end that includes ore sorting. And we know when we put the ore sorting in there, our recoveries range from about 71 to 80% when we include the ore sorting component. The back end of the circuit, so from the mill through to final production, is still the 86.7% that we saw previously during the operations. The ore sorting itself, we've looked at it and it actually improves our head grade by on average 30%. So if we're getting 600 ppm from the mine and feeding that into the crusher, post ore sorting, we're able to feed 800 ppm into our mill. And that has a significant impact both on our production profile and also on our cost through diluting our fixed cost component. The other one is acid recovery. So we're able to run the nanofiltration circuit. We're going to be expanding that circuit, and we're able to recycle about 60 tons per day of acid from the back end of the circuit to the front end of the circuit, which means we reduce our acid consumption by 25%. And when we know that acid consumption or acid costs make up about 15 to 20% of our C1 costs, that is a significant benefit for the project. Our infrastructure on site remains in good condition. There's two things that we've been working hard on. The power one, which I've referenced previously. So our new power or hybrid power concept considers that our power source, when we get back up and running again, 28% of it will come from the acid plant, from that steam turbine I spoke about, 39% from the grid, 25% from a combination of solar and battery, and only 8% comes from the diesel gensets, compared to the previous operation where 100% of the power came from the diesel gensets. Now the cost for us to do the connection to the grid, is around $13 million, and our average weighted cost of power for the project is just over 10 cents per kilowatt hour, and that excludes the capital rebate that we're going to get for refunding from Eskom, the Malawian utility, for the $13 million that we spent on the grid connection. We've also worked hard on our tailings. We've been able to optimize the existing tailings dam that exists. We believe that through the extension or the addition of additional lifts on that TSF, we can now store almost 7.5 years worth of production in that tailings dam. The last 2.5 years, that material will be disposed of or stored in the mined out pit. So as you remember, when we were talking about mining, the 6 years worth of mining and 4 years worth of stockpile treatment. So we'll be able to put the tailings back into the open cut pit for those remaining 2.5 years of production. As I also mentioned, we're making sure that we comply with the latest standards out there. Specifically, GISTM is one of the standards that we're looking at that gives us the guidelines around the stability targets we need to reach. And our design improvements have allowed us to increase our factors of safety around the tailings dam as well. So just regarding ESG, really, really important part of the project for us. We believe that Kayelekera will become one of the lowest carbon emitting process plants of its size across any commodity in the world. Our forecasted carbon emissions from our power generation set at just over 8,000 tons of CO2 per annum, and this is a 72% reduction compared to the historical operation. By comparison, when we look around other process plants out there treating different commodities, admittedly, but at that same scale of 1.4 million tons per annum, produce on average about 73,000 tons per annum of CO2. We aspire to be a responsible uranium producer. We want to be building strong relationships with our communities. We want a safe and healthy work environment, and we want to make a positive contribution to a carbon-free future. That is Lotus's goal moving forward. And when you look at what we're doing with our communities, our expectation is when we start the project back up again, there will be over 600 jobs created for the local community. We are committed through our community development agreement to spend 0.45% of our gross revenue on community development projects to uplift our local communities. So a really key part of it, and really one of the things why we're getting such good reception from the local communities, from local government, from the Malawian national government, and from the NGOs in the area. I just want to talk a little bit about the timeline going forward. So as we've said, we've completed the feasibility study now. We are busy in the moment talking about offtake and financing, and post the completion of those discussions, we'll then be able to make a final investment decision. However, we will not make a final investment decision until we have a uranium price that we're comfortable pulling the trigger on. Post the final investment decision, the plant refurbishment will take us between 12 and 15 months. And that means that we could then be producing within 18 months of us making that final investment decision. We could be shipping our first product off to our customers. Do you want to talk a little bit about the board? So we've been growing the board and we've been growing our management team over the last year or so. Myself, who I'm sure many of you have heard speak before, Michael Bowen is our non-exec chairman. Dixie Marshall is our new non-exec director. Lots and lots of experience in advertising communications across various programs, across various platforms. And she's been exceptionally useful in terms of getting our messaging out there. Grant Davey, who I'm sure lots of you know, is also a non-exec director, as is Mark Hanlon as well, with many, many years experience in the finance and resourcing sector. We've also been building up our management team. So again, myself sitting there, Michael Board is our new Chief Financial Officer. He's been in the role for just over 6 months now. Dr. Robert Rich also joined us late last year as our marketing executive. He's based over in the US and is really leading our negotiations or discussions with the various utilities around offtake. Theo Kate is our general manager on site, many, many years of experience in Africa and running projects and running mines. And Dr. Grain Malunga, a very, very well-known entity in Malawi, an ex-member of parliament, an ex-minister of mines, is our country manager and is also on our board of our local subsidiary as well. And this is the final point. So just talking about the ore reserve. So as we've said, we declared an ore reserve for the project, 15.9 million tons at a grade of 660 ppm for just over, or sorry, for 23 million pounds of uranium. So next step, so what are we looking at now? So I think prior to making the final investment decision, there are a number of areas that we are focused on at the moment. We are busy negotiating with the Malawian government around our mine development agreement. Robert is busy talking to the various utilities about offtake agreements. We will be initiating financing negotiations for the project. We need to finalize the agreement with Eskom for the connection to the national grid. We'll be preparing an operational readiness plan so we can start the project up. And we'll also be finalizing the scope and costs for the front-end engineering design work, as well as any programs of site-based early works as well, really to give us a bit of a leg up. And then maybe just as a last comment there, just on the right-hand side there, you can see our capital structure. At the moment, we have a market cap of around 290 million Australian dollars based on our share price today of 24 cents. We have, as of the end of June, we had available to us 5 million Australian dollars unrestricted. We also have associated with our bond another 15 million Australian dollars, but that is restricted cash. Our capital structure at the moment, our most significant shareholder set is Retail Australian. Management owns a significant portion of the project or of the company still. Institutions at 23%. And we are starting to build our retail presence in both the USA and the global as well. So Nathan, that's the end of the presentation, and I'm happy to turn over to you to answer any questions.
Thank you, Keith. Your first question is Bob Rich starting to engage more with the utilities following the release of this DFS?
Yes, so Bob's been busy for the last couple of months, actually. He's been working quite hard for the last 8 months or so in terms of really, let's say, reintroducing Kayelekera to the various utilities and introducing Lotus as a company. I think, as we've mentioned in previous presentations and previous webinars, and that Kayelekera, when it was operating previously, did sell the product into the North American market, and there are a number of utilities that have already processed or used Kayelekera material. So we're going through the process of re-engaging with them. Robert, myself, and Michael attended a conference in Montreal in late April, early May, where we spoke to a number of the North American utilities. And myself and Bob and Michael are also off to London at the end of this month to attend the World Nuclear Association's conference, and also have an opportunity to talk to the various European and Asian utilities as well. So we're really starting to ramp up our discussions with the utilities, and we have made sure that we're on what they call the request for proposal list. So we are starting to see now roll through to us these requests for proposals coming through from the various utilities that we can now start to bid on as well.
Thank you. Just a reminder that if you would like to ask a question, please enter it into the Q&A panel within Zoom. Your next question comes from James Bull at Canaccord. Writes, you clearly have scope to increase the mine life through resource to reserve conversion. What is the pathway to achieving this?
So I think there's a few things we're having a look at from that area. I do believe there is an opportunity still around the Kayelekera deposit itself to grow that, to be able, as you've said, to convert more of that resource into reserves. But we're also looking outside of the pit area as well, or outside of the existing mining license. So we announced a few months ago the results from our exploration program at Livingstonia. We've got 4.6 million pounds sitting at Livingstonia at the moment in inferred classification. We've been doing some drilling in some other areas, including Toowoomba as well. So we're taking a multi-stage or multi-targeted approach to this. We're looking around the existing resource, which is the easiest one for us to do. But we've also know there's some really interesting prospects out there that could be potentially satellite deposits in the future. And I think, as I've mentioned before, one of the things we would look at is perhaps doing, for example, at Livingstonia, we'd do the open pit mine there. We may do the crushing and ore sorting there, and then actually truck the ore sorter concentrate from Livingstonia back up to Kayelekera for treatment. So there are certainly lots and lots of opportunities for us to be able to extend this life of mine.
Thank you. Your next question has been asked a few different times, but in short, they're asking if you could share your thoughts on what's the appropriate uranium price to reach a final investment decision.
Yeah, it's difficult to pick a single number, let's say, of what that uranium price is going to be. I think the way we want to try and approach things is that we look at what our costs are, and we want to make a decision that if we can sign contracts, so these are long-term contracts, if we can sign those contracts at good prices that allow us to, for example, and I'll pick some numbers, just to make the calculation easy. Say if we're able to sign contracts at $60 per pound, and we have a cash cost of $29 per pound. We would put half of our material into those contracts so that we are sure that we have covered 100% of our cash costs. We can then use the other remaining 50% of our production to perhaps be a little more aggressive with and either go into the spot market or go into short-term contracts and all that. So it's not a single number we're looking for. It's more of a, where is the market sitting at the moment? Today, the price is $48 per pound. That's certainly too low for us. I think we'll be looking for something above $60 per pound before we enter into any contracts. And that contracting strategy will then be driven by what we have as our cost at that point in time, as well as how much we're able to put into those contracts as well. Thank you.
And just, can you please give an update on the rare earths and what's happening there at the project?
Yeah, so as people will know, we announced some time ago that we're doing some drilling up there at the rare earths. We had done some work early last year where we had done some trenching and got some really, really interesting results from the samples we took from the trenches. We did some drilling late last year. Those samples have been submitted in for assay. We're getting those results back now. We've gone back into the field again to do some resampling around some of the trenches as well to confirm some of those numbers. And we're also doing a bit of mineralogy work around it. Our initial assessment of the deposit is that it is quite patchy, and we're just trying to understand it a little bit more before we announce the results back to the market again. But there will be an announcement coming in the relatively short period where we'll be talking a little bit about those rare earth, about the rare earth deposit.
Thank you. And just in terms of raising money for the project, what is the company looking at? Debt, equity, combination?
I believe it's going to be a combination. I'd certainly look at what the other uranium companies have been doing to raise their funds for their restart of their projects, and they've gone the full equity route. I still think there's an opportunity for some debt financing to come in there. And I believe a simple way of doing it is to look through our working capital and maybe raise how much we need for working capital through debt. We also know in a number of conversations we've had with traders, and there's been quite a few traders that have approached us over the last 6 months or so, that quite a few of them are prepared to do some upfront payments if we do sign contracts with them as well. So that's also something else that we could consider as a financing option going forward.
Thank you. There are no further questions at this time, so I'll now hand back to Keith for closing remarks.
Yeah, thanks very much, Nathan. So again, appreciate everyone jumping on this call to have to listen. I hope I've been able to explain the results of the feasibility study. As I did mention, we're very, very excited about the results. We believe that all the things that we've been talking about for the last 18 months or so regarding ore sorting, regarding power, regarding tailings, regarding acid, I think we've hit every single one of those targets. And I'm really, really happy to see that those have actually come through in the study to realize not only a operating cost or a cash cost that I'm extremely comfortable with moving forward with, but also that our capital costs are still being well constrained. And that is all being done within this incredibly high inflationary period at the moment. So I'm looking forward to taking questions from everybody else as we move forward. There's a number of conferences we'll be attending as well. So I'm looking forward to getting the story out to everybody.